Commercial property valuation methods. Seeking to stable returns, investing in commercial real estate has become more popular over the past few decades. The value of a property is one of the most important factors for investors when making investment decisions. In this video, I share with you my experience and commercial real estate valuation methods to calculate a property's value, providing a brief overview of each method and then delve into some of the factors that make these methods more challenging in practice than they initially seem to be. Each concept estimates the value of a property at a specific point in time. They have merit in different situations, but they also have the same drawback. It is important to mention that comparisons to market factors are one of the most important inputs to any valuation method. Cost approach analysis. The cost approach is an estimate of how much it would cost to build the structure from an empty piece of land and includes the value of the land as well. Using cost approach, we tried to determine whether it's less expensive to purchase an existing property or to build a new property. So the cost approach method is divided to the reproduction method, which is the cost of rebuilding an exact replica of the existing structure using the same materials, construction methods, condition, etc., and to the replacement method, using the cost of rebuilding the structure with new materials, construction methods, and design. This method doesn't account for the additional effort of development and construction involved in erecting a building. Also, it does not account for the long-term cash flow potential of a property. Sales comparison approach analysis. The sales comparison is a great way to determine how the market values properties that are similar to the subject property. This involves analyzing other properties in the market that have recently sold. Some of the major components discovered during the comparison analysis is price per square meter, price per unit, price per key, capitalization rate, physical condition, location, income and tenant profiles, stability of cash flows, and more. Once the characteristics of the subject property are compared with those of the comparable properties, adjustments are made to reflect any attributes that are either more or less favorable for the subject property, and then a final determination of value is made. The more similar the comparable properties in terms of type, location, use, condition, etc., the more confident an analyst can be in the metrics used to value the subject property. However, like the cost approach above, the sales comparison method doesn't capture the long-term cash flows an investor can expect during the hold period of the property. Income capitalization approach. The method is one of the most used methods of property valuation in both the lending world and for initial analysis of an intended acquisition. The capitalization rate method is a valuable tool to use when attempting to estimate the current market value of a property. The formula used is dividing the net operating income of the property by the capitalization rate. The resulting number is the approximate value of the property based on the expected cash flow during the first year of ownership. This method is most valuable when the cash flow for the property is stable and relatively certain. This method is not attempting to value buildings with little to no NOI, since the accuracy of a valuation using strictly a cap rate approach would be suspect. Discounted cash flow approach analysis. In order to understand why valuations at a specific point in time are a drawback, we first need to understand how real estate investors measure the return they will achieve over the hold period of a property. If an investor holds a property for 10 years from purchase to sale, the overall return will be a combination of the cash flow from each of the 10 years of ownership in addition to any difference between the purchase price and the sale price at the end of year 10. Discounted cash flow approach is the only method that accounts for potential changes in the cash flow or value of the property over the hold period of the property and takes into consideration time value of money and captures the future performance of the property. If an investor knows that in year 5 of the hold period, a major tenant is going to vacate the property and cause a significant decrease in the property's cash flow for a period of time, this will negatively impact the overall return the investor achieves. The discounted cash flow method involves predicting the future cash flows over the estimated hold period of the property, including the annual cash flow and the profit at the time of sale. The practice of attempting to accurately predict revenue, expenses, and the future value of the property at the time of sale forces practitioners think more deeply about long-term risk factors, management, quality of tenants, and trends in the real estate market. While not perfect, since nobody has a crystal ball to predict the future, the discounted cash flow method is preferred by investors due to the fact that the method better matches the reality of the investment than the others discussed before. Other commercial real estate valuation methods. Outside of the three most common forms of commercial real estate valuation discussed in this video, three more niche methods of valuation come into play. Value per door breaks down valuation into a simple tally based on the number of units, primarily used for condos and apartments. Gross rent multiplier is a method that compares an asset's potential valuation by dividing the price of the property by its gross income over the asset's lifetime. Gross rent multiplier can be an effective way to evaluate value-add assets, where there is a low price relative to the property's income potential. Cost per rentable square meter, which combines a tenant's usable space with the building's shared space, then comparing that number to the average lease cost per square meter. Valuing a building based on cost per rentable square meter is a preferred method for high-end assets with top-of-the-line finishes, a premier location, or both, as the value reflects what can be charged in rent to yield returns. Most appraisers do not limit themselves to one method, instead taking an average of two or more methods. In addition to these methods, stress testing is also an important component of valuation. Choosing the right valuation method is like just choosing the right tool for the job. If you have found this video useful, please like, share and subscribe for more videos and write your comments or questions.